Passive income is a beautiful thing, and maybe that's why you're interested in dividend investing. That way you have two revenue streams, one from your day job and the other from your dividends. If you want to bump up your portfolio's dividend yield, then you ought to be taking a look at BDCs and REITs. And in this video, we're going to do just that to figure out which one is better than the other. And what you see on your screen right now is the table of contents, or how the video is going to unfold, the flow of the video. So what exactly is a BDC? It stands for Business Development Company, and at its core, it's a money lending firm that helps to develop businesses with their highly educated team of consultants. At a BDC, it's not unusual to find almost everybody with an Ivy League degree, or equivalent like Stanford, MIT, etc. And in return, they get interest payments on the loans they hand out to these businesses that they're helping out, or they even get equity stake in the business at hand, which I think they prefer, especially if it has a lot of potential and a lot of promise and their future looks bright. All that to say, a BDC, they do not own the businesses, nor do they own any real estate. Rather, they just simply help entrepreneurs and other businesses to scale their operations or improve by providing them with capital, strategic guidance, and a roadmap to stability. Because when you are a startup business, the first 9 to 18 months, super uncertain, and there's a lot of speed bumps and obstacles in the way. But when you have a BDC team in your corner helping you out and telling you what you should and shouldn't do, as a business, it makes your game plan roll out a little more smoothly. However, I have to say, because a BDC's business model revolves around loans, compared to other industries and sectors, except maybe the financial banks, BDCs carry a little bit more risk. But with that said, high risk, high reward. And it's not like they just hand out loans to willy-nilly anybody. When you think about a BDC, they're smarter than that. They have a screening process with criteria metrics in place. That way, not everybody going through their doors will get money lended to them, and they have the option to say no and turn people away. All that to say, if a business is working with a BDC, that means the BDC sees a future that is bright and potential in that client. So as you can see on your screen right now, as investors, you and I, if we put our money into a BDC, we give them the money, and then they turn that money into loans that they hand out to these middle market companies. Sometimes they're a little bit bigger, sometimes they're a little bit smaller, and in return, these businesses pay their loans on time every month or every quarter or whatever their contractual agreements, obligations say, goes back to the BDC. They take that money and they give out 90% of that to you as dividends. That's BDCs in a nutshell. Moving right along to REITs. What is a REIT? Well, it stands for Real Estate Investment Trust. And REITs own physical property, unlike the BDCs. So a REIT will have a portfolio full of warehouse facilities, commercial buildings, or even shopping centers, and then they rent it out to the clients. So you can think of them as kind of like a Airbnb, except unlike an Airbnb, they're not going to tell you to fold the laundry, to mow the grass, and to file your taxes for them. None of that nonsense. And the contract agreements are usually like a 5-year lease or a 10-year lease. It's not short-term, like day-to-day or 30 days. So I guess between you and me, an Airbnb was a terrible example to compare a REIT to, but they own property and they rent it out to people who need it in order to operate their business. So it's kind of like real estate investing without any of the hard work. Because with real estate investing, your hands get dirty. There's a lot of work that goes on behind the scenes, but also with your paperwork, and it requires a lot of your time and effort. But with REITs, you can buy into one and sell out of it the next day. Super simple, very easy. Now, unlike a BDC, a REIT needs to have a high occupancy rate so that they can make rent money with the properties that they have, because these are physical assets. If they don't have a very high occupancy rate of like 90%, that means the other 10% they're losing money on. They're either maintaining it or trying to work out a contract or a lease agreement with potential clients. What you want to see is REIT have a occupancy rate of at least 90 to 95%. If it's up there in 100%, that means of all the assets that they own, they're making money on all of them. So depending on their strategy or portfolio, some REITs are more stable than others. And the high quality ones usually navigate through the downturn economic events smoothly as corn on butter. By the way, next time you have corn on the cob, dude, put a little bit of melted butter on that thing. Ooh, so good. Yes, I used to live in the South, more specifically Georgia and Mississippi. When I got introduced to butter on corn, dude, life-changing. Now, what do REITs and BDCs have in common? Kind of like ice cream. It doesn't matter if you're fat, skinny, ugly, or handsome. Dude, everybody likes ice cream. Even old people or children, ice cream is a fan favorite. Now, I remember growing up, my most favorite ice cream brand was Häagen-Dazs. Dude, it just hits differently. However, these days, I would say my guilty pleasure snack is cheese. I know, call me weird. That's the name of this channel, right? Dividend Compounders with Cheese. Oh, by the way, hi, my name is Amos. I actually am a huge fan of cheese. And my favorite one so far, the variety, dude, pepper jack. You give me a stack of pepper jack, I'll do whatever you want. I'll go over to your house, I'll paint the walls, change your baby's diaper, I'll do whatever it takes. Just give me some pepper jack cheese. Anyways, back to the video, talk about their shared attributes. Well, number one, both BDC and REITs, they have to pay out at least 90% of their earnings out as dividends. And that's because they do not have to pay corporate taxes. So instead, your dividends that you receive from a REIT or a BDC, it's going to unfortunately be taxed at your ordinary income bracket, whether that's a good thing or a bad thing. And they both tend to possess very high dividend yields, and that's by design because they have to pay out 90% of their earnings as dividends. So it's not high because it's a trap or because anything is weird or sketchy. It's by design. And what they also share in common is that in a high interest rate environment like it is right now, inflation times, it squeezes their margins because both of them have to take out loans in order to grow. And that's because they don't really have that much cash left over in order to reinvest into the company or to buy more physical assets or to hire more employees. So taking out loans is by design, just like paying out a high dividend. And what's also by design is diluting the shareholders because through issuing more shares, they can also raise capital. Now, if you're okay with all of that, we can move on to the next slide, which is the head-to-head comparison. So BDCs, they do tend to have a higher dividend yield in comparison to REITs. On average, yes, you can show me an outlier example and say, well, this one pays higher. Stop it. I'm saying on average, okay? BDCs, their dividend yield is around 10%, give or take plus or minus like 2 or 3%. Sometimes they go as high as like 17%. I would avoid those ones. Sometimes they go as low as like maybe 6.5 to maybe 6%. Whereas REITs, on the other hand, well, their dividend yield usually ranges from about 2 to about like 6 or 7%. So BDCs, their dividend yield much higher. And also, BDCs, they do not own any physical assets, as I alluded to earlier. Instead, they make profit through the loans that they hand out, interest payments that they get back from their clients. And also, when it comes to BDCs, their portfolio of clients, it tends to be pretty diversified across all sectors and industries. So say they have like 200 businesses that they work with, about like 20% will be in the retail sector, 10% will be utilities, 15% would be medical technology startups, 5% will be car washes, and so forth and so forth. So by investing into one BDC, it's kind of like investing into a S&P 500 index fund. Now, on the other hand, when it comes to REITs, they do tend to be a little more popular with the retail investor because their market caps are usually 3x or 5x that of their equivalent BDC counterparts. And REITs, as their name might suggest, they own physical real estate, and their portfolio of real estate, it tends to be specialized, meaning they're not diversified like BDCs. So with a REIT, it's not uncommon for them to just specialize on shopping malls or commercial real estate or just residential homes or RVs. But what is not common is to have a REIT that's just diversified across all sectors and industries. It just doesn't really work that way. They usually specialize on one group of the business world. And I'm going to be honest with you, this one's kind of a weak argument, but some people do label REITs as an inflation hedge because as inflation goes up, so do the rent prices for their tenants. However, if you just put too much price pressure to your tenants, they could cancel the lease obligation and say, dude, we just can't afford it anymore. We're going to declare bankruptcy. It does happen from time to time, but from what I have seen, if it is a very high quality REIT, their occupancy rate during an economic downturn, it'll go from like, for instance, 95% down to like 89%. Or in the case of like Realty Income Corporation, it'll go from like 99% down to like 98.7%. So people do tap out saying we just can't pay this rent anymore, but it's not as crazy as you might imagine in your head. It never goes from like 99% down to 15%, unless we're talking about a very crappy REIT that is ran by a bunch of morons for the management team. And to that, I would say avoid those REITs at all costs. And now let's go ahead and take a look at what the data and the market trends say about both REITs and BDCs. So historically, REITs have outperformed the market, aka the S&P 500, until very recently. Ever since the 2020 pandemic, REITs as a sector as a whole, they've been underperforming and lagging behind the S&P 500. In the past 50 years, the total return on a broken down annual basis for REITs is 12.7%. So when you think about the share appreciation and the dividends, they outpace that of the S&P 500 10%. Same exact time period. And if we only look at the past 25 years, well, that story continues. With REITs, year over year, your money would have grown at a rate of 11.4%. Whereas for the S&P 500, it was 7.6%. And if we just do 20 years, well, for REITs, it was 10.4% year over year. S&P 500, 9.7%. But like I just said, ever since the pandemic, the REITs have just not recovered and rebounded because in the past 5 years, their total return year over year was 10%. S&P 500 was 15.7%. And if we look at just 2023, well, the S&P 500 had a remarkable year. Total return was 26% in one fiscal year. For REITs, it was 11.4%. However, the data and history shows us that REITs did outperform the S&P 500 until very recently. Keep that in mind. And when we take into account the past 30 years or so from 1984 to 2023, for the S&P 500, every single year on average it went up by 10%. And when you compare that to the subgroups of REITs, well then the best performers for this column right here was the self-storage units. Pretty shocking to say the least. Right below it, industrial warehouses and facilities that rented out to the folks in the supply chain industry, and then residential homes, healthcare. The worst performing REITs are the ones that had diversified portfolios at 7.9%. Pretty crazy stuff. But if we look at the REIT subgroups broken down into the more popular categories, well then this is pretty interesting. This data is tracked since 2015 for data centers. Year over year, the data center REITs, their return has been 15%. That's pretty darn good. Exact same time period, S&P 500 was 11.9%. And when we think about the telecom REITs, I think about cell towers, right? Like Crown Castle International or American Tower. Well, their total return year over year since 2012, 13.7%. For the S&P 500, they beat them slightly. Right, it's like telling someone you're 6 foot and then your cousin says, well, I'm 6'1". Well, theirs was 13.9%. I guess I'm pointing this out to you to show that not all REITs are created the same. Some perform better than others and some are higher quality than others. Now, on the other side of this argument, when we think about BDCs, when we compare them to the other dividend-paying assets that we recognize and are familiar with, such as bonds or REITs or treasury or utility stocks, well, check this out. On average, BDCs, their dividend yield, as I alluded to earlier, 10%. Much, much higher than the other asset classes. On average, REITs, their dividend yield is about 4.4%. So if a BDC, you're getting double that and some more. It's like a dividend compounder with cheese. But that's the situation surrounding the BDC's dividend. What about their performance? Well, this is where it gets a little weird. Stick with me. When we look at the BDC index for the past 10 years, on average, broken down year over year, the total return has been 8.9%, which I think is pretty respectable. I think that's pretty good. To have a 9% return on your investment year over year, I'm not going to be complaining. However, this is where it gets a little smelly and a little funky, because when we compare the BDC index to that of the S&P 500 in the exact same timeline of the past 10 years, well, the S&P 500, their CAGR was 12.5%. So that means the BDCs underperformed the S&P 500. But this is where it gets pretty ugly. If you are not paying attention, this is where you might want to listen closely. Or if you're pooping, this is where you want to pick up your phone and take a look at what's going to show on your screen. When we look at the price total return for the BDC index, no bueno. Year over year, their total return has been negative 1.6%. Dude, that is trash. That is atrocious. That's only if you look at their share price appreciation. And that's because it's been relatively flat, or I guess on the decline year over year, whereas their dividends have been carrying them on their back, especially in regards to their stock market performance. Share price alone, negative 1.6% year over year. But because they pay such a high dividend yield on average of 10%, it evens out, right? You get a total return of about 9% year over year. So in the grand scheme of things, not too terrible, but share appreciation alone, not the prettiest picture. Now, what you see on your screen right now is the share price performance for ARK, one of the biggest, most popular BDC stocks out there. It stands for Ares Capital. In 2004, they were trading for around $15 a share. You fast forward about 21 years later, and now they're currently about $21. Which means ARK went up by about 42%. And that's because, in theory, BDCs usually keep your share appreciation relatively low to flat, as we just learned in the previous slide. But even though the stock price is not going to grow or decrease that much, their dividend yield should remain relatively stable or even be growing year over year. And in the case of ARK, it's around 8.8%. So in theory, the share price for a BDC should be relatively flat, and the dividend yield should be very high and be consistent and stable, unlike yield max ETFs, because those equities, dude, it crushes the underlying asset and they have like a high dividend yield of like 20 or 30%, but the share price goes from like $100 in year one down to like $5 by year 2 or 3. That's a terrible investment and return on investment. I'm going to be quite frank with you, that's as ugly as it gets. What good is it to get such a high dividend yield if your underlying portfolio value is just going to be crushed? Imagine you have $1 million invested into yield max funds. By the end of year 2 or year 3, it's going to be valued at like $100,000 or even $50,000. You're going to lose everything unless you take the dividends that are paid out and you reinvest it back into the portfolio, at which point your portfolio would just be $1 million 2-3 years later. I'm going to move on before I get too many keyboard warriors coming after me defending yield max ETF, saying, you're wrong, you're an idiot, what do you know? Dude, there's too many people in love with yield max ETFs. On the other hand, in theory, REITs tend to grow in their share price over time alongside with a decent dividend yield. I don't think it'll ever reach that of a BDC of like 10% or 9%, but the dividend yield is still respectable with a capital R. The example that you see on your screen is Prologis, ticker symbol PLD. And they're basically in the business of renting out industrial facilities and warehouses for companies that are in the e-commerce supply chain business. In the exact same timeline of 2004, it went from about $37 a share to what it is today, $112. That means without taking the dividend into account, their share price for Prologis, a REIT, has 3x. Multiplied by 300%. I think that's pretty beautiful. And I think their dividend yield is pretty good too, 3.5%. I mean, it's on the lower end for a REIT, but I think that's still pretty darn good. So with a REIT, in theory, they grow in their share price and they also have a pretty modest and respectable dividend yield. Not ultra high like a BDC. However, I'm going to show you something crazy because here are some exceptions to the rule and to the theories that we just discussed. These are outlier examples and not to be the common accepted thing. Now, what we are looking at is Main Street Capital, one of the more popular BDC stocks out here. And Main Street Capital is really unique in that it kind of behaves like a growth stock that also has a very high dividend yield. Case in point, when we look at 2007, their share price was $15 a piece. You fast forward throughout the years, now it's $58 a share, which means it went up by 288%. That's pretty darn good. That's almost 4x your initial investment just on the share price alone. When you factor in the dividend yield, dude, even more juicy, even more pretty. This is a dividend compounder with mozzarella, Parmesan. Beautiful. It's popular for a good reason. Now, another exception to the rule that I want to show you is in the realm of REITs. And their name is Realty Income Corporation, the monthly dividend paying REIT, ticker symbol O. And their share price in the exact same timeline of 2007 to that of Main Street Capital, they traded for roughly $28. You fast forward throughout the years, and now they're roughly $56 a share. Or in other words, they only doubled in valuation, which is still pretty impressive, but it pales in comparison to what Main Street Capital was able to accomplish in the exact same time period. And to add salt to injury, or to add a salt to my wound, or to put your finger into my gash wound and swirl it all around, their dividend yield is 5.7%. Main Street Capital, well, their dividend yield is also 5%, except your share price appreciation, 288%. But for Realty Income, your share price only went up by 100%. And I say only went up by. That's still good, impressive, and I would take that any day of the week. Sign me up. And as we move along to the next slide, we're still going to be looking at the data and what market trends tell us about BDCs versus REITs. Now, in the past 9 years, if we put the biggest, the baddest, most popular BDCs against the most popular, baddest, and most recognizable REITs up against each other, who would have won? Well, that's what I investigated and found out. And the results, dude, pretty shocking to say the least. Now, representing Team BDC, I had Main Street Capital in this portfolio, ARC, and Capital Southwest Corporation, which, fun fact, Main Street Capital is internally managed, but also Capital Southwest is internally managed. And on Team REIT, we have Realty Income Corporation, Triple N, and ADC. All three of these REITs are in the commercial real estate space. And as a refresher, the timeline is January of 2016 to February of 2025. Who do you think is going to win? Pause this video, comment down below. Who do you think is going to win? Because I was shocked. You ready? In 9 years, let's take a look at BDC. Your $10,000 would have transformed into $42,400. On the other hand, with REITs, the exact same timeline, the exact same amount of principal money of 10 grand, well, it only transforms into $21,000. That's pretty wild. When we take a look at the CAGR broken down, taking into account share buybacks and the dividends paid out, well, for BDCs, the CAGR is 17%. Dude, that's absolutely bonkers. For Team REITs, the CAGR was 8.4%. So my takeaway from this is that you would have been better off investing into BDCs rather than REITs. At least in the past 9 years, that is the case. And when we take a look at their performance visually, I would say they were pretty close in the race up until the pandemic when both of them crashed. By the way, the teal is Team REIT. The dark blue line is Team BDC. During the pandemic sell-off when everything was hairy and smelly, BDC, their portfolio was about $11,000. For REITs, it was $13,000. But the difference is the BDCs not only rebounded and recovered, but they also reached new highs and they keep going higher and higher. Whereas the REITs had a modest recovery, I would say in 2022, and they have stayed relatively flat. They have not reached new highs. They're pretty much the same prices that they were back in 2020. Now, what makes all of this even more interesting is that Morgan Stanley published this research article that states the obvious that REITs are absolutely undervalued right now as an asset class, and they're supposed to get a rebound rally once the interest rates go down. However, right now, Jerome Powell and the Federal Reserve, they're kind of like, I don't know if we want to decrease it, and Trump is like, dude, decrease it. They're going back and forth. We'll see what happens. But maybe that's why REITs have underperformed the BDCs. It's just not their time to shine. Let's see, Morgan Stanley goes on to say, we believe there will be a REITs breakout when quantitative tightening morphs into quantitative easing. The reason is that history tells us REIT total returns have a strong negative correlation to interest rates, a relationship that certainly persists today. The key takeaways from the article: REITs have significantly underperformed the broader U.S. equity market over the past 5 years, primarily due to the effects of COVID-19 and rising interest rates. As a result, Laurel Durkee goes on to say that REITs are inexpensive today, especially when compared to the broader equities market. So when it comes to recommendations, I would still argue that for anyone less than 55 years old or in your working years, you might be like 61 but still working, you would also qualify for this advice. A REIT probably makes more sense than a BDC in your portfolio. Unless the trend stays permanent and BDCs become this hyper growth stock class, but also with very high dividends. Then of course, what I just said goes right out the window. BDCs would be absolutely the winner in every single scenario case for any age bracket and group. Because if the money's gonna grow, but also the dividends are very high, that's a no-brainer. That's if that trend stays consistent and permanent. However, I think for the patient investor that has chest hair and some pubes on your head because you're balding, I think REITs are a really good opportunity. I echo the sentiment with Morgan Stanley for that rebound rally that they're talking about that usually happens historically once interest rates get cut. And I think it's going to be coming soon. Maybe in the next year, maybe in the next 2 years. I think the time for REITs to shine is going to come, or maybe it won't come, and we'll continue to stay in this very high inflationary environment, and REITs will underperform BDCs for the next 10, 20, and 30 years. But when it comes to in retirement, I think both REITs and BDCs, they make a lot of sense in order to increase the quality of your portfolio's dividend yield. Because my whole thing is, if you only have SCHD in your portfolio, I think that's pretty darn good. You get what, like a 3.5% dividend yield? But if you introduce some BDCs and some REITs, that average dividend yield could be bumped up to like 5 or maybe even 6%. And that can make a huge difference from getting a dividend income of like 40 grand to that of 60 or 65 grand per year, at least for year one. And then it's going to continue to grow on top of that, right? Dividends compounding is really a thing. The only investment class that I feel strongly against, no one should have it in their portfolio because it is a value and a yield trap, are the yield max ETFs. And I said it earlier, they have a cult following, and I know I offended some people, and I don't even know you. I apologize first of all, but dude, they're yield traps. What good is it to have a yield max ETF in your portfolio if the value of your portfolio just drops month after month, year after year? Dude, it's better to have an asset class that is sustainable, that is quality, that is growing or slowly growing. Maybe I'm just not thinking and seeing clearly. If you are investing into yield max ETFs, what's the investment thesis behind being bullish for having that in the portfolio? You can change my mind. Maybe I'm just not educated. Maybe I'm just misinformed. Let me know. I am always open to changing my mind. Unless it comes to the idea of abandoning my Seattle Seahawks to support the San Francisco 49ers. Never gonna happen. Go Hawks. Dude, we just picked up Cooper Kupp and Sam Darnold as our quarterback for this upcoming season. I know I said it earlier, but I am stoked. I think we're going to go pretty far. We should have been a playoff team this year. It's just that the NFC West is stacked. Every one of us is so freaking good. But this year, 2025, pretty excited for what's going to happen. And with that, my final thoughts. So I've been buying into a REIT recently because I think they're undervalued right now. And in 5 years, my heart's deepest desire is that you'll subscribe. No, my heart's deepest desire is that I'm going to be happy with my decision-making process by buying into this REIT. Will I regret this decision? Only time will tell. As for you, which REITs and BDCs to buy, to recommend? I made a deep dive video ranking all of the best BDCs, as you can see on the left side of your screen, and on the right side of your screen are all the best REITs to see which ones are worthy, which ones are ugly, which ones are just kind of average. I kind of understand why you would have it in your portfolio but wouldn't belong in mine. Everything far and in between. And I get it. When you see the thumbnail and the video length previews that it's going to be like an hour or an hour and like 19 minutes, you might feel the same way as this comment. It says, when I saw this video was going to be almost an hour and a half, I cringed in disbelief. Then I started watching. Within 6 minutes, I realized this was going to be a valuable lesson in BDCs, and all it was going to cost me was an hour and 20 minutes of my life. Instant subscription, thanks for making this. Dude, I'm telling you right now, give me a chance. Watch those videos. I know they're long, but you're going to learn a lot in those videos. And I think maybe that's the reason why a lot of people choose not to click my videos. Maybe it's the length that intimidates people. Maybe it's the trash thumbnails. I get it. My thumbnails, not that good. I can definitely improve in that department as a YouTuber. But if you do decide to watch one of those three or all three of those videos and you feel like it was a waste of your time, you let me know and I'll buy you a glass of beer. Seriously. Anyways, you made it to the end of the video. Please do me a solid. Click like on this video if you like this type of content. Obviously, there's no flashy edits happening every 2 to 3 seconds. But if you like this kind of conversational YouTube style, feel free to subscribe so that you don't miss future uploads. And if you want access to extra content that's not on YouTube, or if you just want to support me, then join the Patreon. Dude, I would be super thankful and grateful. Anyways, I love you guys. Stay safe. Good luck in the stock market, and I'll talk to you next time. Peace.